Welcome to the deep dive. Today we're starting not with an exciting opportunity, but with a recent and pretty sharp financial failure.
Yeah.
We're talking about a R130,000 loss that's left a measurable dent in your portfolio. But this isn't just about licking wounds. It's about converting that failure.
Right.
The delisting of African Rainbow Capital Investments into, well, the foundational blueprint for your next big South African investment move.
Exactly. We're using the pain point of RCI's failure not as a lament, but as a rigorous validation engine for a new high-conviction thesis.
Okay.
Our mission today is clear. We need to move past the simple, painful cash loss and quantify the true economic damage, the opportunity cost.
Before diving deep into what you're projecting as a R2.2 million South African fintech banking opportunity for 2026?
Yes, and that's the key.
Okay, so let's unpack this. The source material you shared, it details a pretty rigorous portfolio analysis that looks at the IRCI disaster to justify a massive strategic pivot.
It does. And this bet targets two primary contenders in the banking space. Old Mutual Bank, which we'll just call OM Bank.
Yep.
And the really dynamic Sanlam TymeBank joint venture, GOtyme.
And we're projecting a 10-year return here, right? From 2026 all the way through 2035 on a staged R150,000 allocation.
And that transition is just so critical. If we rush past the RCI failure, we lose the urgency needed to execute the new strategy correctly. The sources show exactly what happens when capital is misallocated, and that lesson is really the price of admission for this new opportunity.
So let's start with the hard numbers on that RCI loss. The delisting happened on May 28, 2025, with an offer of R9.75 per share.
Right.
The analysis confirms that your initial R130,000 investment recovered only about, what, R63,000 to R65,000?
Yeah, that's right. It's a 48 to 50% cash recovery,
Yeah.
which is, it's just devastating.
That cash loss is terrible, but what's structurally fascinating is this hidden discount you mentioned.
That's the real story here. The sources highlight that the R9.75 offer was deeply flawed because RRCI consistently traded far, far below its net asset value in kind, or INAV.
The INAV.
Which stood at our 12.78 per share.
Wait, okay, let me just make sure I have that clear for the listener. The company was forced to buy back the shares for R9.75, even though the underlying assets they held were actually worth R12.78 per share.
Precisely.
So you not only lost half your money, but the recovery mechanism itself forced you to sell at a huge discount to the actual value of the portfolio.
It was a compounding loss.
Yeah.
And that brings us to the most painful number of all, the opportunity cost. What did that R130,000 not earn while it was tied up in a failing structure?
This is where the analysis gets really compelling. If we use the gold standard comparison, what you call the Capitec differential, the figures are just staggering.
If that R130,000 had been deployed into Capitec Bank shares in, say, mid-2020 at R2,000 a share, that same capital would be worth R253,000 today.
Wow.
That's a 95% gain instead of a 50% loss.
Yeah.
When you do the subtraction, you realize the foregone growth and the realized loss created a quantifiable R320,000 opportunity cost differential.
That figure is shocking. But it brings us to an even more critical point. Even if we look at safer, established blue chips during that same period.
Like Sanlam, Old Mutual, Discovery.
Right. The analysis shows the foregone profit swing was still around R152,000 to R155,000.
And we have to talk about the non-financial costs, which is the time. The sources quantify this failure as 50 to 100 hours of wasted research effort.
That's 2 full weeks of evenings and weekends spent studying a dud.
Yes. And that wasted effort, if you reallocated it, could have saved 6 months of entry timing on the Capitec-style 10x opportunity we're looking at today.
And the sources quantify that potential saving as
Our 1.2 million to our 2.5 million in foregone upside.
that is the real human cost of poor capital allocation. It steals your focus from the true winners.
Which is exactly why we need to dig into why RCI failed structurally. It wasn't just a bad portfolio. It was a flawed vehicle from the start.
So why wasn't that R12.78 INAV ever realized? Was it a lack of confidence in the assets, or was the vehicle itself the problem?
The vehicle was the problem. It was structurally compromised. As a closed-end fund, it faced two major issues. First, there was no redemption mechanism.
Meaning you couldn't just get your money out?
No. If you wanted out, you had to find a buyer in the market, leading to this persistent discount to NAV. The holdings were illiquid, and the valuation was based purely on sentiment, not asset value.
And the second issue?
It's Mauritius domiciliation. It created an 8 to 12% implicit tax penalty relative to just holding direct South African equity.
So you were basically paying a tariff just to own a passive holding company that lacked any operational edge.
Precisely. And this is the core differentiator we have to focus on now. IRCI was passive. It lacks the crucial ingredient of operational leverage that successful banks like Capitec possess.
No fixed costs spread across a rapidly growing customer base.
Exactly. That lack of an operational moat doomed its valuation, whereas a bank's valuation, it scales exponentially with customer acquisition.
That insight transitions us perfectly from failure to the blueprint. The 2026 investment thesis, it rests entirely on the Capitec precedent. We have to believe its success is replicable, at least partially.
It's the unavoidable benchmark. To validate the potential of OM Bank and GOtyme, we have to look at Capitec's explosive history.
Okay.
The analysis shows that a hypothetical R1000 invested at Capitec's 2002 IPO at R8 per share would be worth approximately R487,500 by November 2025.
That's what, a 48,750% total return.
A mind-boggling 46% annualized return over 23 years.
That 46% annualized return just sounds like hindsight bias. Is there any scenario where OM Bank or GOtyme can even reach half that? We need to know what elements they have to replicate to even get close.
They must replicate 5 core structural elements that Capitec mastered. First, the underserved market.
Right.
Capitec didn't challenge the big four head-on. They targeted the lower income segment, people earning R1,000 to R10,000 a month. By doing this, they expanded the addressable market by bringing 20 to 25 million South Africans into formal banking for the first time.
And the second, and I think you'd agree, the most critical point, is the structural cost advantage.
This is the competitive moat. Capitec's cost-to-income ratio averaged 38% over 20 years. Now, to put that in context, the industry average for the incumbents is 56%.
So that 18 percentage point advantage is pure profit margin.
Pure profit. They achieved it by keeping a minimal branch footprint, with each branch serving over 27,000 customers, and by forcing digital interactions whenever possible.
And that cost advantage translated directly to profitable growth, the engine being that high-margin unsecured lending.
That's right, which generated 18 to 28% interest rates, fueling their 26 to 30% headline earnings growth in recent years.
And of course, the scale created massive network effects. With 24.1 million customers, Capitec holds an insurmountable data advantage.
And high switching costs. Their systems and processes are now just integrated into the daily financial lives of most South Africans.
But the sources are clear that 46% won't repeat. I mean, we are talking about a totally different financial landscape now.
Absolutely. The challengers face headwinds Capitec never did. First, market timing. Capitec enjoyed first-mover advantage and macroeconomic tailwinds of 4 to 5% GDP growth.
And the new entrants.
They're fighting on a mature, saturated battlefield. Second, the law of large numbers. Capitec serves 60% of South African adults. Their growth rate has naturally decelerated from 38% CAGR down to about 8% CAGR. There's just less pie left to conquer.
And finally, multiple compression. Capitec trades at an expensive 28x forward earnings. A new bank, it's likely to start trading much lower at 8 to 15 times PE.
Which means future appreciation will depend almost entirely on earnings growth, not the dramatic revaluation that Capitec saw early on.
This brings us to the contenders who believe they can achieve the next best thing, that 35% annualized return. Let's start with OM Bank.
Okay, OM Bank officially launched in August 2025 and is directly targeting Capitec's core base, aiming for the R1,000 to R30,000 per month's earners.
Their CEO frames it as a late mover advantage, arguing they can observe competitors and avoid infrastructure mistakes.
And leveraging Old Mutual's 180 years of trust and 7.5 million existing customers for cross-selling. Their plan is sound on paper.
They're built on cloud-native architecture, partnering with 10x banking.
Specifically with the ultimate aim of approaching Capitec's 38% cost-to-income ratio. But this strategic choice comes at an incredible price.
Which raises an important question. How much is Old Mutual willing to spend to compete with a 24-year market leader? The commitment is, it's breathtaking.
It is. Old Mutual is projecting annual losses of R1.1 billion to R1.3 billion through 2027, projecting break-even only in 2028.
So that's a staggering cumulative cash outlay of R5.85 billion to R7.05 billion before they even break even.
To justify pouring R7 billion into this venture, OM Bank must acquire 3 to 5 million customers by 2028.
So they have to capture 12 to 20% of Capitec's entire base in just 3 years. That target seems aggressively ambitious.
It is. And the execution risks are very real. The late mover disadvantage is huge. Capitec has decades of data, and TymeBank already has 15,000 retail points of presence.
And we can't ignore the integration complexity. TymeBank has to migrate over 400,000 legacy money account customers to the new platform while running parallel systems for a year.
Yeah, and historical case studies show that poor bank migrations lead to 25 to 40% customer churn. Losing even 100,000 customers in that process would significantly set back their aggressive 3 to 5 million customer target.
Okay, so we have one challenger, TymeBank, betting R7 billion on a high-risk, high-reward greenfield build. Now let's look at the second contender, GOtyme, the joint venture between Sanlam and TymeBank. This play feels different, more about scale and immediate structural advantage.
It's an immediate powerhouse merger, leveraging existing assets. You've got Sanlam's R120 billion market cap, 15 million customers, deep insurance expertise.
Combined with TymeBank's existing 17 million customers and, crucially, those 15,000 retail points via Pick and Pay and Boxer kiosks.
Right, and the deal gave the joint venture immediate revenue leverage in the form of a performing loan book. TymeBank acquired 50% of Sanlam Personal Loans' existing R5 billion loan book.
Meaning the JVCo immediately holds R2.5 billion in performing loans.
This matters because the engine of high-growth retail banking is unsecured lending. This segment offers net interest margins of 12 to 18%.
Compared to what, 3 to 6% on mortgages?
Exactly. A R5 billion loan book at a 15% IM generates R750 million in gross interest income. So while TymeBank is burning billions, GOtyme starts with R750 million in revenue potential immediately. It just accelerates their path to profitability significantly.
And their distribution strategy is a huge structural moat that directly attacks the cost problem.
100%.
Yeah.
By acquiring customers through those in-store kiosks, they drive down their customer acquisition cost, or CAC, to just R200 to R400.
Yeah.
That's dramatically lower than the R600 to R1000 or more that digital-only players have to spend.
So their growth trajectory is inherently more profitable and faster.
Yes, they can cross-sell insurance to TymeBank's 17 million customers and loans to Sanlam's 15 million customers. The source material projects their unsecured loan book growing potentially to R70 billion to R90 billion by 2035.
So what does this all mean? We've looked at the cost of failure, the benchmark, and these two contrasting strategies. Now we need to synthesize these projections for your staged R150,000 allocation over the next decade.
Okay, so we modeled the expected value based on a balanced allocation, R75,000 to each entity, weighted across bull, base, and bear scenarios. And the numbers, they're pretty compelling.
For TymeBank, the analysis projects an expected value of R1.25 million from your R75,000 allocation. That's a 16.7x return on capital.
Which translates to an annualized return of 32.7%.
And for GOtyme, which you view as slightly less volatile because of its foundation.
For GOtyme, the expected value is R971,250, representing a 12.95x return on capital, or a 28.5% annualized return.
And the combined portfolio value, the true goal of this whole thesis totals?
R2.22 million.
Okay.
The total expected value of combined allocation is R2.22 million over 10 years, which translates to a 35.6% compound annual growth rate, or CADR.
So while that falls short of Capitec's historical 46%, a 35% annualized return is still substantial, far above market averages, and justifies the risk.
Absolutely. But, and this is a big but,
given the IRCI failure, the key is execution. You can't just dump R150,000 in a lump sum, given all the risks we've talked about.
No, absolutely not. The source material is very disciplined on risk mitigation, emphasizing a staged capital deployment strategy.
Okay, break that down.
Instead of a lump sum, the recommendation is to allocate R25,000 in year 1, 2026, as exploratory capital to test the thesis. Then R50,000 in year 2 for growth, scaling the winner.
And the final R75,000 in year 3.
For maximum scale, yes. This approach maintains optionality and, it reduces that catastrophic risk.
And to overcome the capital constraint you mentioned in your sources, the failure to scale because of trapped capital, there's a critical second recommendation.
Right, which focuses on leveraging your analysis.
And that is?
The necessity of structuring a small investor syndication opportunity. The idea is to contribute your R150,000 as the lead investor, turning your research into valuable intellectual property.
And then seek R250,000 to R500,000 from external investors.
Yes. This boosts total deployed capital, increasing the potential upside from that R2.2 million significantly, all while reducing your personal exposure. You'd maintain a substantial 23 to 37.5% ownership of that syndicate.
So the IRCI failure was a costly lesson in allocation discipline and the danger of passive holding companies.
A very costly lesson.
The opportunity now is to target the structural shift in South African retail banking towards digital, low-cost operational models. The 35% annualized return thesis seems robust, provided those execution risks are managed via that staged deployment.
Absolutely. And the monitoring framework is as important as the initial allocation. What's fascinating here is how sensitive the strategy is to Capitec's competitive defense.
What do you mean?
Well, if OM Bank's cost-to-income ratio worsens quarter over quarter for 3 consecutive quarters, meaning their unit economics are failing to scale, that's a clear trigger to pull back capital.
Or if Capitec responds by cutting customer fees by 20%,
That would fundamentally undermine the value proposition of both challengers.
so the most critical factor is not the initial valuation or the partnership structure,
No.
but whether either company can sustainably match Capitec's 38% cost efficiency. They have to create an equivalent moat.
If the ARCI failure taught us anything, it's that structural strength matters more than initial hype. So which company, OM Bank, with its R7 billion in cash burn, or GOtyme, with its immediate revenue and distribution moat, has genuinely built a structure strong enough to withstand Capitec's inevitable response? That critical distinction should be the focus of your monitoring, and it will determine whether you realize that R2.2 million or repeat the R130,000 error.